Amortization of a bond premium. On July 1st, 2012, Georgia Peaches issues $2 million face value, 10% 10-year bonds at $2,271,813. This price results in an effective interest rate of 8% on the bonds. So I just want to explain this for a minute, why that is so. We're going to be paying 10% of $2 million, which is like $200,000 a year interest. That's the cash payment. However, when we sold the bonds, we actually got an extra $271,813. So we borrowed, in effect, $2,271,813, but we're only paying 10% of $2 million. So if you look at the $200,000 that we're going to be paying for interest, based on how much we borrowed, it ends up that we're really only paying 8%. Georgia Peaches uses the effective interest method to amortize the bond premium or discount. In this case, it's a premium. And the bonds pay semi-annual interest July 1st and January 1st. So the entry to record the issuance of the bonds on July 1st is we put in the amount of cash that we received, and then the way I always do it is I then credit the bond payable for the face amount, and the difference between the two is a credit to premium. Okay, so now our debits equal our credits. Second requirement is prepare an amortization table through December 31st, 2013, which basically amounts to 3 interest periods. So let's go to our amortization table. Now this first line is when we issue it on July 1st, 2012. So the way you calculate this is $2 million plus the unamortized premium. I also like to just write in here that this is basically the sales price. What did we sell it for? Well, we sold it for $2,271,813. And the unamortized premium is the full amount of the premium, because we haven't amortized any of it yet. Now the first interest payment is going to be on December 31st, or January 1st, 2013. So the amount of interest that we're going to pay is always the same. It's 5% of the face value of $2 million. Now these are semi-annual interest payments. So 5%, I mean it was 10%, but because it's semi-annual, it's 5%. So that's going to be $100,000. And that is not going to change. You know, whether it's the January, July, January, it's going to be $100,000. So I like to always, whoops, put that in the wrong spot. I like to just always fill that in so that I know I've always got that filled out. All right, now, interest expense. The interest expense is 4%, because that's half of the effective rate of 8%. 4% times the carrying value of the previous period. So 4% times $2,271,813 is $90,873. You can punch that into your calculator if you don't believe me and check it. The difference between the two is the amount of the premium that we're going to amortize. And when we say amortize, it just means we're going to reduce the amount in the premium account by this amount every, well, this amount will change, but we reduce it by the amount that we're amortizing. So 271, let's see how it says D minus C, column D minus column C. 271 minus 9127 gives us 262,686. That's the balance that we have left to amortize. Now the carrying value is 2 million plus whatever we've got in here. So it's going to be 2,262,686. Another way that you could do this is you could take this 2,271,813 and subtract 9127, and you'll get the 2,262,686. Next period, July. Interest paid is the same, but now our carrying value has changed. So 4% times our most recent carrying value gives us 90,507. The difference between the interest and our cash payment is the amount that we're going to amortize of 94.93. 262,686 minus the 94.93 gives us 253,193, and our carrying value is 2,253,193. So it's 2 million plus the unamortized discount. Then for the third time, we take 4 million times our most recent carrying value, and we get 91.28. Difference between those two, 98.72. 253,193 minus the 98,172 gives us 243,321, and this again goes down to 2,243,321. Now I want to point out a couple of things here. One, the unamortized premium is going to get less and less and less, because after 10 years or 20 semi-annual interest payments, the unamortized premium is going to be 0. After 10 years, when this bond matures, the bond carrying value, this number here, is going to be 2 million. It always has to end up that way. Now, if we were going to do a balance sheet at the end of 2013, we would show this amount as the carrying value. And the reason for that is at the end of 2013, 12/31/13, we're going to have to do an adjusting journal entry, which we'll do in a minute. But we're going to have to do an adjusting journal entry to show that we have accrued this amount of interest expense, and also to amortize this premium, because then the next day we're actually going to make the interest payment. So the amount on our balance sheet at the end of 2031 or 12/31/2013 would be, we would show our bonds payable of $2 million plus the premium, and the premium that is in the account at that point in time is $243,321. And so the carrying value, you're going to take 2 million plus 243 gives you 2,243,321. So the nice thing is, once you've got this amortization table, you've got all the information you need to do the journal entries, which we'll do in a minute, but also to prepare your balance sheet. So let's do the journal entry that we would make on 1/1/2013. The interest paid is $100,000. Interest expense is $90,873, and the premium is $91.27. So, interest expense was the $90,873. The premium that we're going to be amortizing is $91.27, and the interest payable. So this is the journal entry that we have to do. It's an adjusting journal entry, and we have to show at the end of 2012 we're going to accrue that interest, and we're going to pay it the next day. But at the end of 2012 we're just going to accrue it. So that's the journal entry, and we're getting those numbers right off of this. This is the January 1st, 2013 payment. If we were going to do the January 21st, 2013 payment, it would be down here. Well, actually, I'm going to wait. I'll show you that when we do the 14 one. Okay, let's do our next journal entry for the July 13 payment. So here's our numbers. July 13. Okay, 100,000 cash, 90,507 interest expense, and the premium to be amortized, 94.93. So interest expense, 90,507. Premium, 90. Whoops, wrong spot. Didn't do that. Like that. The premium, 94.93, and our cash payment is 100,000. Again, at the end of the next period, we have to accrue the interest because we're not going to pay it until the next day. So our interest expense is 91.28. Premium is 98.72. Interest expense 91.28. Premium 98.72. And the interest payable 100,000. Now the next day, January 1st, 2014, the journal entry to actually record the payment of this interest would be debit interest payable for 100,000 and credit cash. Now, one more thing I just remember that I wanted to share with you is when you look at our interest expense, it's getting less and less and less. And the premium that we amortize is getting bigger and bigger and bigger. For a discount, it will be just opposite. And if you looked at a discount problem, you would see that your interest is going to be getting greater and greater and greater, and your discount is going to be less and less and less. But you have to look at a discount table to see that. So the key to getting this all your journal entries right is getting this table right. And again, remember, your initial carrying value is your sales price, and then from there it changes.